One day, you'll want to retire, and in order to do that, try to remember these three important numbers: 1,800, 625, and 79. What could they possibly mean? The first one is $1,800 a month. That's the average amount a 65-year-old Canadian actually lives on right now, from Canada Pension Plan, Old Age Security, and Guaranteed Income Supplement combined. After tax, that's maybe $1,500 to $1,600. To put this into perspective, think about what it costs just to rent or pay the taxes and expenses on your home. The second number is 625, or rather $625,000. That's roughly what a single person needs to save on top of CPP and OAS to generate $40,000 a year in today's dollars for 25 to 30 years of retirement without running out. For a couple who want $80,000 a year combined, you're looking at $1.4 to $1.6 million saved. But what's the reality? Right now, the average Canadian household nearing retirement has less than $275,000 in total retirement savings. That's not even half of what one person needs, let alone two, and the final number is 79. 79% of pre-retirees age 55 plus who were surveyed by the Bank of Montreal are worried or terrified they'll outlive their money. Yet despite this, more than half of them haven't changed their savings habits. So to connect the dots, government pensions equals poverty level income for most. You need roughly $1 million plus as a couple to stay middle class in retirement. The average household is on track for maybe $500,000 to $600,000 total, including your house. That's a $500,000 shortfall staring most Canadians in the face. And not to add insult to injury, everything is costing more. Inflation numbers over the past 10 years have skyrocketed, and the big stuff like rent, property taxes, home insurance, drugs, dental, and long-term care is out of control. So if you don't want those three numbers to get the best of you, here's what you can do starting today. Number one, face the math. By using a proper calculator or spreadsheet, figure out your current personal gap. That's the shortfall between where you are now and where you need to be. Number two, work 2 or 3 more years if you can. Every extra year you delay retirement adds roughly $100,000 to $150,000 to your nest egg between extra savings and bigger CPP and OAS. Number 3, downsize or relocate sooner rather than later, turning your $1.2 million Toronto semi into a $600,000 house in Atlantic Canada or small town Ontario instantly cuts your gap in half. Keep following the same 3 rules we always talk about. Save more than you think you'll need. Keep fees small. And don't blow up your plan when markets get ugly. The fact is, folks, we're on our own. Ottawa's already told us the cupboard is bare. The sooner we stop pretending $1,800 a month from the government is a retirement plan, the better off we'll be. I'm Glenn Zacher. Hit the thumbs up button and subscribe because it's your money.